Economic uncertainty can feel overwhelming. Stock markets fluctuate, interest rates change, and global events create fear and doubt among investors. Most people panic or avoid investing during such times, missing long-term opportunities. But uncertainty is not a threat. It is a natural part of financial systems and a powerful opportunity for those who prepare. In this video, you will discover strategies to invest intelligently, protect your wealth, and even thrive when markets seem unpredictable. Like and subscribe to learn how to turn volatility into advantage. 1. Understanding economic uncertainty. Economic uncertainty is the state where future financial conditions are unpredictable and market movements become volatile. Factors such as inflation, interest rate changes, political instability, global crises, and fluctuating corporate earnings all contribute to uncertainty. Many investors misinterpret short-term market volatility as permanent risk, reacting impulsively to headlines or rumors. In reality, uncertainty is a natural and recurring feature of financial markets. It serves as both a challenge and an opportunity. 2. Assessing risk during uncertain times. Investing during uncertain periods begins with a realistic assessment of risk. Risk is not only about potential loss, but also about the probability and impact of that loss relative to one's financial goals. Investors must evaluate how much risk their portfolio can endure without triggering panic-driven decisions. This includes understanding market volatility, sector exposure, and the potential impact of economic shocks. Proper risk assessment guides asset allocation and informs decisions about defensive positions, cash reserves, and diversification strategies. 3. Diversification as a defensive strategy. Diversification is the cornerstone of stability during economic uncertainty. By spreading investments across multiple asset classes, sectors, and geographic regions, investors reduce the impact of any single market shock. Equities, bonds, real estate, commodities, and cash equivalents behave differently under varying economic conditions. For example, bonds often rise when equities fall, and certain commodities can hedge against inflation or geopolitical risk. 4. Maintaining liquidity. Liquidity is a critical tool for investors navigating uncertain economic conditions. Liquid assets such as cash or marketable securities provide flexibility to respond to emergencies, cover short-term obligations, or seize opportunities during market dips. In periods of uncertainty, markets may present high-quality assets at attractive valuations, but without liquidity, investors are forced to sell holdings at losses or miss opportunities entirely. 5. Keeping a long-term perspective. One of the most essential strategies during economic uncertainty is maintaining a long-term perspective. Short-term volatility can trigger fear, causing investors to sell at lows or miss compounding opportunities. Historically, markets recover over time, rewarding patient investors who resist reactive decisions. A long-term view emphasizes goals, timelines, and growth trends over daily fluctuations. By focusing on sustained progress rather than immediate returns, investors can navigate periods of uncertainty with discipline and confidence. 6. Systematic and rules-based investing. Systematic investing is the antidote to emotional decision-making during uncertain times. Rules-based strategies such as automatic contributions, target asset allocations, and periodic rebalancing create structure and discipline. Systems ensure portfolios remain aligned with long-term objectives regardless of market swings. Investors following a predetermined plan avoid panic selling during downturns and prevent overexposure during rallies. 7. Defensive and countercyclical investments. Incorporating defensive and countercyclical assets protects portfolios during economic uncertainty. Bonds, dividend-paying stocks, and inflation-protected securities often perform better when broader markets decline. Commodities such as gold serve as hedges against systemic shocks. Countercyclical investments, which rise when the broader market falls, create stability and offset losses in other assets. Allocating capital to these positions does not limit growth, but reduces risk and provides optionality. 8. Avoiding emotional traps. Economic uncertainty amplifies human emotions, often leading to mistakes. Fear may prompt selling at the bottom, while greed may drive overexposure during rallies. Successful investors recognize these tendencies and commit to disciplined, systematic approaches. Predefined investment rules, asset allocation targets, and rebalancing schedules reduce emotional interference. Understanding that emotions exaggerate perceived risk allows investors to act rationally and seize opportunity rather than react impulsively. 9. Seeking opportunity amid volatility. Economic uncertainty is not only a challenge, but a source of opportunity. Temporary mispricings and undervalued assets often arise when fear dominates markets. Investors with liquidity, discipline, and patience can acquire high-quality assets at discounted prices, benefiting from future recoveries. Recognizing the difference between temporary market fluctuations and permanent value loss is crucial. 10. Building a resilient portfolio. The ultimate goal during uncertain economic periods is constructing a portfolio that endures volatility while achieving long-term growth. Resilience comes from diversification, liquidity, defensive positioning, systematic investing, and disciplined risk management. A resilient portfolio adapts to changing conditions, reduces reliance on emotion, and capitalizes on opportunity without compromising stability. Investing during economic uncertainty proves that preparation, strategy, and discipline are far more powerful than luck or emotion. By assessing risk, diversifying, maintaining liquidity, and following systematic processes, investors can navigate volatility and seize opportunity. Markets fluctuate, but outcomes are determined by planning, structure, and patience. Like and subscribe to continue learning strategies that protect wealth, reduce risk, and grow investments even in unpredictable economic conditions.